Yeah, welcome to Unlocking the Power of Angel Investing. My name is I'm Nick Sachs, and just as a bit of about my background is I've been working in the sort of the early stage startup sphere for the past 8 years. I've made over sort of 15 investments in my personal capacity, as well as sort of I do this professionally with my own business, Tapio Capital, where I'm the COO, and I run the investment process and sort of help us find deal flow. So I see a lot of new businesses coming in. On top of that, I'm also one of the founding members of our Wealth Creation Investment Club, which is why here this webinar is basically a reason for us to sort of help educate people and spread awareness about the club. Basically, what we are is we're focused on investing in either bringing sort of South African investors to either invest in South African based and South African run businesses. So we've got a global approach that's, if all goes well, will help uplift South Africans globally. Yeah, so moving into it, just just before I start, just a quick disclaimer. This webinar is purely for informational purposes only. It's meant to educate you in what angel investing is. Please don't consider this investment advice in any way. If you do want to make some angel investments, do seek some professional advice and make sure you do your own due diligence on those investments before you make them. Now, now, before now, what is angel investing? Basically, it's when a high net worth individual, sort of successful entrepreneur or professional, they invest a personal capital in these businesses. This normally happens at the very beginning of a person's either be the first or second check of a business's life cycle. And the reason why it's called an angel investor is you're seen as the guardian angel, because mostly these businesses and these startups can't get capital from anywhere else. They're too early stage to get a bank loan, and institutional investors wouldn't necessarily look at them because they are so high risk. It's probably just a guy with an idea, or they've got a sort of platform with an attraction. They're seen as incredibly high risk, but uh, they need some capital to get going. So in terms of where angel investing fits in the private equity landscape, it sort of fits at the very beginning before you get uh, into other institutionals as mentioned. So it'll generally happen at either the angel, pre-seed, or seed stage of the investments, and that's the earliest time you'll do it. Uh, there's also other types of private capital that could come in. You've got venture capital firms. They tend to invest at sort of anything from seed to Series A would be. We're going to what those stages mean in a minute and how they fit into the business life cycle. We also have later stage VCs, which help with growth equity. They come in also after that Series A, and then you have to buyouts, which is private equity firms, and then the other sort of specialist type mentioned, which is distressed PE and special situation type investments. Yeah, in terms of the investment life cycle, generally starts with the business. You have I call them the three Fs, which is friends, families, and fools. Generally, this is when a business is just a guy with an idea. They'll have sort of no validation. They haven't even started developing their MVP. The types of people invest is friends and family. The valuations will be incredibly small, be sort of 50 to 500K, and they generally raise 10 to 50K. Then we have sort of angel investors, which is where if you are an angel investor, it'll come in. You'll invest sort of around 50, participate in rounds of about 50 to 150K. The valuations will be 500 to 1.5 million at this round. It's normally the first or second check. You can invest alongside the friends and family. The founders here would be normally starting to develop their MVP, starting to see some initial traction, started getting some new customers. I'll then move on to a pre-seed. Uh, Here, this is when the VCs start to come in. We have some early stage VCs that invest in this round. They'll want to see quite a bit of traction within the business, make sure the MVP is launched, starting seeing that as mentioned, the traction within the business. And the valuations are around 1.5 to 5 million in terms of pre-seed, and the amounts raised is about 150 to 700K. These amounts are, they're quite flexible. You can get pre-seeds that are 6, 7 million, but I'll call them quite an expensive seed, a pre-seed. Then the seed round, sort of similar, more institutions start coming in. You have your 5 million to 15 million valuations, raising 700K to 1.5 million. And as they go down the cycle to Series A, you then start getting more and more traction within the business, and the investors expect you to meet certain milestones or have certain uh, checklists coming out at those various stages. Angel investors tend to invest at around the pre-seed to angel round to seed. They generally come in. They do. If you want to sort of protect your investment or go into sort of what dilution is, you do something called following on, which is you keep investing at the different stages. That does tend to happen, and angel investors tend to exit around so the Series C or D at that stage. Now, oh, sorry, went back. Apologies for that. Yeah, so different types of angel investing strategies. We have, you could quite simply invest on your own into a different business. So that's you as an angel investor, you find them, you do your due diligence, you then invest directly into that company. Uh, and then on top, or you can join what's called an angel syndicate, which is a pool of angel investors that will come in. If say there's 20 or 30 of you, it's also what we're trying to build within uh, the Wealth Creation Club, is to sort of form these syndicates of angels, or encourage these syndicates of angels to invest directly into startups. Normally, this will be done through an SPV or some type of trust or partnership, and there'll be one nominated individual to represent that syndicate to the startup. This helps keep the capitalization table, the equity structure within that startup quite clean, and not having lots of people join it. You, yeah, we also have angel networks that sort of help connect startups with other angel investors. It's a great way to sort of find these angel syndicates and other people to invest in. You have structured investments, which the equity agreements sort of they convert to equity later. We have advanced subscription agreements, whether it's called that in the UK or in America, it's called simple agreement for future equity. That's basically you sign an agreement now, and you then get your shares later. So you make the investment now, but get the shares at a predetermined time. This allows businesses to raise money consistently. So they don't, generally, when a funding round ends, everyone makes their investments at that one point in time, as opposed to being a continuously. So the funds aren't waiting for this big lump sum to come in. They're able to then draw it out over time. You then have diversification. This is quite important. It follows something called the power rule that's the main strategy within angel investing world. Now, I think they say that most businesses will fail. A lot of these, I think there's only like a 20 to 30, 10 to 20% success rate for these businesses. So expect most of the businesses to fail. So you have to diversify your pool, your portfolio. So if you have 100,000 to invest, it's probably recommended that you spend 10K into 10 different startups. That's how I would kind of think of it, to get that amount to it's not all in one place. Because generally with the power rule, how that then works is the returns from one of your investments will then cover the losses from the other nine that fail. And that's generally how they like to think of it. That's why if you look at some of the funds and how they work, they'll invest at over, I think there's one fund that does over 100 investments in the year. They'll probably only expect 10 of those to do that, but then they'll get about 30 to 48 times their initial investment, and that covers the rest of the losses. And I've got an example that shows you how that works later on. And pros and cons. Starting with the pros. Main pros that you're getting involved in exciting and new technologies. I've had a few where I think some of the cooler ones that I've worked with is a sort of synthetic leather brand where they're making leather out of pineapple leaves. To a business that we looked at recently where they were using AI to form digital clones of people, so they can be seen as consultants. So they can then sell like as a step down if they're charging 30 to 40K, three to £4,000 an hour. They can charge £500 an hour, and uh, someone talk to them. Yeah, so a lot of these, you'll see things at the forefront of technology, which is quite cool. Another one, the pros is you get higher than average returns because of the risk reward element. If things go well with you in your portfolio, then you should get higher than the S&P 500 return. I think the average that you look at is 2 times over five years. In terms of that's what the VCs target. And if you look at the S&P 500, it's about over 10 years, it's about 1.8 times that return. You also have the ability to make a big difference in these startups. That's quite a cool, it's quite a good pro is that these businesses are starting off from scratch and that they need a lot of mentorship and advice. So that we're relying on their investor base to help them out and advise them on how to continue and become a success. There are a lot of tax advantages, particularly in the UK. I'm not sure, I'm not a tax expert, so I'm not sure what sits in South Africa for those who are joining from South Africa. But in the UK, I'll go say if you don't have SAS and ES, it's not worth making that investment. You can get up to 50%, you get up to, I think it was around 70 to 50%, depending on the structure of that back in sort of tax relief event. So it's a big incentive and protection for investors. Yeah, I'm not a tax expert, so please, do your research on what that is before you come in and make any investments and go for it. You need to understand what that SES and EIS are, particularly in the UK market. Now, the cons, as mentioned, most of these businesses fail. So your capital is at risk, so you might lose your entire investment. That's where that diversification is quite critical. Particularly in early stage investing, you can't have all your eggs in one basket. Another thing is that these investments are incredibly liquid. You're not going to get your money back for about 5 to 10 years, and you're at the whims of a founder when they will actually want to exit the business. So they might decide to keep it and not exit. So it might even be longer than 10 years. But that's generally the average of what it is, that you're not going to get your investment back. So be prepared for that. Another thing is just valuation uncertainty. Valuations at early stages are done. There's not much in this business, so you can't use a traditional discounted cash flow or multiple. They're done in sort of like a market-based approach, and also on how much equity a founder is prepared to give up in that business. So if they want to if they need to raise 100,000, but want to give up 10% of the business, then the valuation is going to be $1 million. And that's how but then they have to come back and justify why it's worth $1 million using sort of traditional methodologies. But that's often it's just seen as the price that people would pay. Going on to how to find startups. The main way I like to find startups is at networking events, such as one that we put on last year in November with the SACC at our Wealth Creation Club. We had 66 opportunities pitching, and all of them were looking for new investors to come in. You could also, as mentioned, use angel networks. They do run a lot of events similar to what I mentioned, what we're trying to do. And they also have databases of startups that are trying to raise that you could also reach out to and have conversation. There's also LinkedIn. A lot of the time, I have founders reaching out to me on the platform. If you put angel investor in your title, you have a lot of people reaching out to sending you pitch decks. And that's also a great way if you also do your own research and sort of scout that way, using finding different businesses. There's also something called crowdfunding platforms. That's a great way to start your angel investment journey. You don't need as much capital. Normally with direct investments, you need about, I'd say, minimum 5K to start to make an investment. And that's excluding what you want to, if you want to have any sort of diversification. It's also a good way to practice doing some analysis and understanding what is expected. With these platforms, the main ones are called Crowdcube and Seeders. You can invest 10 to 100 pounds. So if you only have £1,000, you can put 10, £100 investments into different startups, and it's a great way to look and start looking at these different businesses. And lastly, you have your personal network, which is people you know. In your network, you might be starting a business who you might like. You might want to add that value for them, and that's a great way to find new investments. Uh, yeah, so with the different with the different things to ask for you. So you need to conduct due diligence. One of the main things when I start out is the with receiving data from a startup is the pitch deck. So the main thing has to look up. There's a structure of things that to look up, which we'll go for in a minute. But this is the first thing that you should get. If you're happy with a pitch deck and you're happy with what they said, you can do a more detailed analysis asking for their business plan, which is normally a 10 to 20 page document that outlines everything about the go-to-market and all that wonderful stuff, as well as analyzing their financial forecast to make sure that what they plan to do seems realistic. Often with these financial forecasts, I tend to ignore their revenue and like to see how long they last, but I'll go into a bit as to why that is. And if you're happy with both of those things, there's more other due diligence items you can look for, sort of letters of intent to customers, bank statements, to see if they have a bank account, what their current bank balances, and if they've been receiving, if they say they've received any revenue, has it actually come in? It's another good thing to check. And then also, if there's any legal agreements that they have and prior shareholder agreements that could potentially dilute you down in future. So you want to make sure that if there's any binding agreements that it's not detrimental to the company and it doesn't have any risk opposed to that. Yeah. Then how to evaluate a startup. The first thing I look at is probably the most important thing to evaluate is the team. We need to know, are they the right people to take the business forward? Uh, you know, are they honest? Do they have the same value set as you? Are they experienced? Do they have any industry experience? Or have they done this before? In terms of, are they second time founder, first time founder? What is their age? Where they're at in life? This might sound a bit bad, but we were looking at a startup and we're chatting to this founder, and he said that he couldn't continue the business because he was about to start a family. So making sure that, as well as sort of seeing how many jobs do they have, checking their LinkedIn's to say, okay, well, uh, is the startup this person's main priority or this founding team's main priority? Because the last thing you want to have is someone doing lots of other different things that takes away from running this business. And I've learned that the hard way, where we've invested in a business, invested time in a founder, but he was so distracted that the business ultimately failed and he wasn't able to drive anything forward. Uh, Problem and solution. This is now also quite critical to the business. Where is the problem something that some people will pay for, and then does the solution actually address that problem, and will people pay to solve it? Often when it's too niche, it could be too niche that there might not actually be a market for it. So link to having that link to is there a problem and solution is quite critical, because people tend to they might be quite passionate about it. Like it could be, for instance, I'm seeing a lot of things in the neurodiverse world, but that's only affecting a smaller part of the population. And there's a lot of businesses at the moment that are actually popping up with that. But is it something that people will pay to solve is a big question. And in terms of the market, that sort of links to the problem and solution. Is the market big enough to support what they sort of expect to sell, and does it make it worthwhile? You have things called TAM, total addressable market, SAM, serviceable addressable market, and SOM, serviceable attainable market. And we'll need to analyze these to see if it makes sense. Founders do tend to overvalue the vet of what their market is. I think I had one founder once. He was doing like a normal beverages business and said like, well, his market is everyone in the world because they and sell to everyone in the world. It's like, well, it's not really. You're probably going to focus on the UK first and then go out globally. So it's not 7 billion people. It's probably population of the UK, and within that, certain demographics that you want to focus on. So here I will recalculate what what the market would be in terms and compare to what they say. I will use my my calculation as a port, as well as sort of looking at the competitors. Is it overly saturated? We had this in the ESG world uh, in 2021 and 2022, where hundreds of different ESG reporting startups came up. So that's kind of a red flag if you're an investor, where you don't want to be seen as, well, it's not that there's only so much space for these type of things. So if it's a hot industry, it might be too hot. You want to just see who's doing what and make sure that there's not too much competition there. Uh, and also in terms of that, on the flip side, if there's no competition, that can also be seen as a bad thing, as because why don't people want to uh, why don't people want to why is there no competition, and why aren't people solving this problem as it is it too difficult? So you have to ask these types of questions. Another thing, if you're happy with the market, is there a USP that can protect and differentiate themselves within those market competitors? Can they create a protective niche, sort of that people will pay to solve, then they can clear out, carve a portion of that market for themselves. Another thing to look for is being within the competitors, that they become a complementary service. So they're not actually competitors; they complement complement what they do. Uh, t- no, the next thing is traction. So again, as we mentioned, letters of intent from customers, pilot programs, early revenue. This is quite important depending on the stage that you look at. I look at when we invest as Tapio, we look at sort of the seed pre-seed market, where we expect some revenues, a lot of traction coming in. Or have they been able to prove their problem and solution in terms of this? Is there validity that they can prove in terms of that the business will be a success? And that's where the traction comes in. The next is runway, and this is quite important in terms of you analyzing the financial model. I tend to ignore the revenue and make sure if the business made no money, can they last longer than 12 months at their on their current plan, current business plan? Because the last thing you want, if it's less than 12 months, what that basically means is that the business will have to start fundraising straight away. They'll have to close the current round and start raising money, and that becomes a distraction for the business, where they don't have enough time to reach that next milestone that if a pre-seed going to seed, the seed type investors will expect to see. As mentioned, you have SEAS, EIS. That's the advanced assurance. So a business will supply a sort of certificate to you, so you can ask a startup for this. What this basically is a rubber stamp from HMRC, say that they'll they'll be able to get these tax breaks. Again, not a you'll probably do on SES and ES, we'll probably do a whole another session on this. It's a very nuanced and complicated space in terms of what to do. But at the moment, I would suggest just doing some research into that, making sure you understand what that process is. Then lastly, IP. Are they able to protect the IP in the business? Do they need to? Have they been able to start filing any patents? And what is in place to protect their business? Yeah. Then we've got a case study. So let's say you invest £10,000 in a startup valued at £3 million pre-money. So the difference so there's two types of valuations you get. You get pre-money and post-money. So basically all it is quite simple. Is pre-money means it's before the investment round comes in. So here 3 million pre-money when they're raising 200,000. It gives you a 3.2 million post-money, which is simply the 3 million plus the 200,000. And then this business is SEIS assured. So what that means, you should receive equity of around 0.3125%, which is 10,000 divided by 3.2 million. You'll get a tax benefit from because your SEA is assured, which is 50% of your investment comes back. That's in money, so you get that back almost straight away. Your projected, say in 10 years' time, you projected exit value is 100 million. So while as time goes on, if you don't do the follow-on investments, the investor will, or the business will keep adding on more and more equity. What then happens if you think of the investments as a pie? It will dilute your current shareholding. So you'll be diluted by around, on average, about 54% over the term of the investment, which will take you down if you don't follow on. If you do put more money into these investments at the different funding rounds, you can keep your 0.3125%, but if you don't, you'll come down to 0.168, 169% due to the 54% valuation. This then means at this 100 million exit, your investment is worth 168,000. And if you factor in the tax benefit you receive, you've then 33.75x to your initial £5,000 investment. So let's say if you've got a investment portfolio of 50,000 that you have to spend, and you want to do 10 investments into SEIS assured startups, then you could potentially get about 16x that 3 point sorry, my math's gone a bit bad. About 3 odd x your investment, which is higher than what you could get in the S&P 500 over the same period of time, which is 1.829x x investment. So it is what's the word? There is a lot of there's a lot of potential to do quite well, but also if you get it wrong, that's why diversification is important. So it's again, sorry, we're taking a step back. That's assuming the 3.0x, assuming only one of those 10 investments works. You'll get 3.x times on the 50,000 doing 10 investments. And that's almost double what you get for the S&P 500. Yeah. So yeah, any questions? Yeah, sorry, I probably should mention. If you have any questions, please put them in the Q&A, and I will get to as many as I can. We have a few that have come through. One from Mark sort of saying, interested in hearing about valuation methodologies for early stage companies that might be first of its kind. So there are a few methodologies that businesses use. They use sort of multiple based approaches. So as you go down the approach, we're comparing it to the market, which is done on, as you know, on revenue or EBITDA. There's a few which have gone blank on the name, which use checklist methods. So if basing it basically on, does the founder have a lot of industry experience? Does the founder have might give you another 100,000 valuations. Do they have traction? Might give you another 100,000. There's a lot of these checklist-based approaches that are used, particularly at the early stage. Those are the main ones that come through. And then some of the other questions. One of the ones that's come through is what industries or sectors are exciting at the moment. So it's a good question. I would say that what mainly people are looking at is AI or anything with AI. It is getting a bit overdone, whereas every single investment is either putting every single investment is putting a sort of what we call lipstick on a pig, which is where you basically take ChatGPT or one of the other AI providers and you just put your business in front of it as a shop front. So AI is really hot at the moment. As mentioned, seeing a lot in the neurodiverse space that's coming through. So yeah, there's AI is probably the main one. With the rapid advances in AI, does this present an extra risk as well as an opportunity where technology outpaces a business's plans and renders the services provided redundant, or creates essentially a free competitor? Potentially, it depends on what that business is. That's something you'll need to look at, on a case by case basis. So the answer is yes. For example, if you wanted to, there's a new technology sort of in the accountancy world that can be done quick, repetitive, and they're trying to do that. You don't necessarily in the tech world, you don't necessarily see many of those businesses that could be replaced by AI. It's generally the other way around, where AI is replacing those businesses. Yeah, so from Jason, what's the first step one would take to get going? I think the first step is just to do research, make sure you understand what's out there in the market, what people are investing in. Start going to networking events, uh, understand what the different nuances are, how to actually evaluate a startup, start practicing it. As mentioned, you can look it into crowdfunding where you can risk lower amounts of money to sort of get the hang of practicing and looking at sort of what it actually feels like to do an investment. And then yeah, lastly, how does setting up a syndicate work? You could either form them through what's called a bare trust or a limited liability partnership or a simple company. What's important there is just to make sure that they're structured properly from a tax perspective and you get the various what's it called benefits that come through in terms of the SES and US from a UK perspective. Brilliant. Yeah, that's it. So yeah, thanks everyone and have a great day.